All right, so chapter 10.1 is going to be dealing with receivables and bad debt. All right, so of course, receivables, right? Because we're in the business of doing receivables, that means that we give the customers a generous allowance, kind of in a sense where they can owe us money. Now, because we trust our customers so much, to customers, it's their form of cash or right or some kind of credit that they can purchase from us. But the one thing that we also have to consider is if we allow them to owe us the money, right? What are the chances they are actually going to pay us, right? In full, right? Because if you've been in business before, right, you have to also assume the possibility that a customer can fault on their payments. So, and that's what this entire thing is about, right? We're going to be talking from receivables, how to recognize the things that our customers owe us on an account. Then we're going to look at it in a scenario where they don't pay us, and then to the conclusion where we write off that bad debt because it becomes uncollectible. So again, a receivable is basically us giving customers pretty much a credit limit or some kind of cash to buy our products or service. Okay, but they owe us the money. Okay. Now, allowance for doubtful accounts. Okay, it's going to be, I'm going to introduce this to you. So, what allowance for doubtful accounts is going to be a contra account to accounts receivable, right? So, for instance, we understand that accounts receivable is when customers owe us money. Well, what if one day our customer tells us they filed for bankruptcy, right? They can no longer afford to pay us anymore. All right, or they just don't have enough money for this month, right? They'll pay us a portion of the money, or for lastly that they just aren't willing to pay you, right? So with this account for allowance for doubtful accounts, it's basically a placeholder for us to place aside, right? Because it's a contra account. It decreases the amount the accounts receivable. But what this little contra account acts as if, right? Again, it's a placeholder to put the money that a customer owes us aside, because the one thing that we need to assume is if they do tell us one day that they can't pay for it, right? They may have a possibility to pay in the future. Now, of course, most businesses would just write it off as a bad debt. Reason being is because they're not going to be chasing down this customer and expecting them to pay, right? Who would, right? They can hire debt collectors to get the money for you, but in this case, this is just a fake situation, right? We place the money in a separate account that decreases our accounts receivable. But again, we're not getting rid of that money just yet. We're keeping that pile there just in case. Now, the three key factors that we understand about allowance for doubtful accounts is one, we know exactly who is not going to pay us, right? They're going to either call us and say they cannot pay us. A debt collector might even call us and say, so and so owes you money. I'm sorry, they filed for bankruptcy, or, they can't pay you, right? Someone has to inform you that this customer cannot pay you for X amount, for X reasons, right? Okay, so you're going to know who. And you're going to know exactly how much, because when we go dive into our fictitious business, right, we're going to have a ledger. Okay, it's going to be called the subsidiary ledger, which keeps tracks of our vendors and our customers. So, it's good business practice to also keep track of how much a certain customer owes us. So if I get a call from someone, from Mr. So-and-so, right, I can pull up his account and know exactly how much he owes me or she owes me, right? So you're going to know who, you're going to go how much, and you're definitely going to know exactly when. So in this case, right, the day that they call you and tell you it can no longer pay you, you know the exact date. Okay? So those are the 3 key factors of one, to determine how to associate an allowance for doubtful accounts, but what are the key characteristics that determines of you even creating the allowance for doubtful accounts, right? You know who, you know how much, and you know exactly when it happens. So for you to create this allowance for doubtful accounts, so again, it's a contra account. It's going to reduce your accounts receivable because so-and-so is not willing to pay, cannot pay, etc., etc. Okay? So, for example, we have here, okay, on December 16th. Am I missing a slide? Okay. Okay, so on December 16th, Mr. Sanchez buys $100 of toys on account. He pays us, he pays us every month, right? Starting on January, and then on March 20th, he files for bankruptcy and he can no longer pay. Okay, so in this case, we're going to record the transaction at hand, right? We're going to assume that he's just a customer and he's going to pay us back, and we have him on account. So in this case, we have Mr. Sanchez on accounts receivable for a total of $100 for the sales of toys, right? Then we're going to record every single month he's paying us. So in this case, it's not here, but in January, we record that he paid $20. In February, we record that he paid us $20. So in this case, he owes us a grand total of $60 because $20 in January plus $20 in February is $40. So here, he calls us and says, I filed for bankruptcy. I'm sorry, I can't pay you back. So now we need to make the assumption that, okay, we looked up Mr. Sanchez's account. We find out he still owes us $60, all right? I'm going to write this off by transferring into a contra account, right, to decrease the account of my accounts receivable. Okay, so I'm going to transfer the $60 that I'm supposed to be collecting from Mr. Sanchez and decreasing my accounts receivable here by $60. Okay, and again, we still have the possibility to collect the money from him. Okay, again, the allowance for doubtful accounts is just a placeholder, right? It's just a placeholder for us to separate what we actually can be receiving from what we can no longer be receiving from. Right? So that is how you deal with the allowance for doubtful accounts. Does this make any sense? Is this good? Is this clear? Okay. So what you're going to notice is that this can happen during the year, during any given period, right? It doesn't matter whether it's 10 months from now, 6 months from now, or even a month from now, right? It's going to be during the period, and then it will make sense when I move on to the next section. Okay? So now we have bad debt expense. Okay? So what bad debt expense is, it's going to be considered an adjustment, okay? So it's going to happen at the end of a given period. Okay, so when do you ever decide to when you want to claim this bad debt, right? So what this bad debt is when you've exhausted every method that you can to try to claim this money and this person, and you just absolutely cannot claim it at all, right? And you've come to the very final straw. This is when you can accept that you're going to file this bad debt. You're going to have to write it off, all right? So that's why we're going to create an account called bad debt expense, and it's going to be an adjustment to your overall accounts receivable, right? You're just going to get rid of it, and you're going to take it as a loss, okay? Now, with that being said, right, you need to understand this, because once you've exhausted everything, it just becomes bad debt. Now, how we make this assumption, okay? So in the previous one, right, when we have an allowance for doubtful accounts, we recognize that we know who, we know exactly how much, and we know exactly when. Now, with bad debt expense, we're going to include not just only Mr. Sanchez, but we're going to include everybody else. Now, this is where a company is going to make an executive decision. Like, look at their overall accounts receivable. Okay? Now, realistically, okay, in a perfect world, 100% of those accounts receivable will be collected. But because we live in the real world, anything can happen, right? Again, a pandemic can happen, right? Anything can happen to prevent you to pay this debt off. So what the company needs to do is they need to make an assumption that not everybody's going to pay you. So that is why for the who, we don't know who is exactly going to fault us on their payment, right? So let's say all of you owe me money. How do I know? By making a prediction. How do I know that Lynette's going to pay me back? How do I know if Talia's going to pay me back? How do I know if Adina's going to pay me back? I don't. I just have to trust that they will. Now, this is where I'm going to make an estimated amount to assume that Lynette may fault on my payment next month, right? I am just going to make that assumption. So this is where you're going to make an estimated guess to kind of figure out a certain amount of, possibility, right? The risk factor of having people owing you money. How much of that money is actually going to not be able to be collected? So it's going to be uncollectible, right? Now, do I know how much? I don't know how much. If let's say Lynette owes me $100, how do I know she's going to pay me the full $100? Right? So this is where the estimated amount is going to come into play, right? We're going to make a safe estimate, right? We don't know who, we don't know how much, and lastly, we don't know when, right? What if Adina owes me money, but she says, I can't pay you this month? Okay, and then she says it again, I can't pay you the next month, I can't pay you the next month, and to the point where I'm like, okay, I don't ever know when you're going to ever pay me back. So this is where this bad debt expense is going to come into play, because what we're going to do is we're going to look at all of our accounts receivable as a collective. We're going to assume that a portion of it, right? It could be the entire class doesn't pay me back. We're going to assume that a small percentage of those people are not going to pay me back. And I'm going to determine that based on the total amount of accounts receivable. And when, I don't know when, so at the end of the period, at the end of the given period, I'm just going to write it off. Okay? So this is why we use a bad debt expense. And it will make more sense when we actually start clarifying and understanding when we do the examples. Okay? So when we're dealing with bad debt, there are exactly two different methods of writing off bad debt. Okay? So we have the direct write-off method and we have the allowance method. Okay? So for those who are in QuickBooks, this is all going to make more sense now, right? Because we learned how to write off our bad debt in QuickBooks. Well, here, this is the reason why. So if you use the direct write-off method, right? You're actually directly taking the bad debt off right away from accounts receivable. You're not going to think twice about it. You're just going to take it right off, okay? Now, this cannot be done. Why? Because you are not the tax accountant, right? This is for tax purposes only, okay? So again, QuickBooks is actually primarily geared towards tax. If you did not know that, little fun fact, it's actually geared towards tax, right? By you doing QuickBooks, by you doing accounting on QuickBooks, it makes it easier to file taxes. So for this scenario here, we're not going to focus on the direct write-off method because you guys are here for bookkeeping. You're not here to be a tax accountant, all right? Okay, but I do want you to recognize that there is two different ways to write off our bad debt, all right? And one of them is the direct write-off method, which would, again, directly take it out of accounts receivable. But we're also going to be introducing to the second one, which as an accountant, this is what you normally do because this is going to occur during the period. It's going to be it's called the allowance method. All right. This one is governed by GAAP. So GAAP is the reason why they tell you to do this, okay? Especially for accountants, not your tax accountant. This is just regular accountants, okay? And there are two ways, again, with the allowance method, there are two additional ways of how you can report this bad debt. And that's going to be either one, the balance sheet method, or two, the income statement method, okay? Again, we do not use the direct write-off method, okay? We only use the allowance method for regular accountants, okay? So now we're going to be looking into our first example of the balance sheet method. Now, so for those who have seen the balance sheet before, in order to actually create the balance sheet, right, we're looking at our assets equals our liabilities and our equity, right? So what you will see on the balance sheet is you will see your accounts receivable, all right? So in this case, let's look at the top corner real quick at the little box in the right corner. So there are key things that you can do. This is just a way that you can easily recognize it and be like, boom, it's that method. Okay, so I give you a little hint over here. So first thing that you're gonna recognize is the estimated amount. All right. Second thing you're gonna be looking for is the word accounts receivable. The third thing that you're going to be looking is the balance in the allowance for doubtful accounts. So in this case, if it's a debit balance, you're going to add. If it's a credit balance, you're going to subtract. Okay? Now, what does that even mean? So let's look at our scenario and see how it's worded. All right? So it says here, for example, it is estimated that 25,000 of a 500,000 accounts receivables is going to be uncollectible, okay? All right, there is currently a debit balance of $5,000 in the allowance for doubtful accounts. Journalize this adjustment. So, here you go. The three things that you need to know. What is the estimated amount? So, it is estimated that 25,000. There is your estimate. So you need to take $25,000, okay? Now, the next keyword is your accounts receivable. If you notice, all right, 25,000 of the 500,000 accounts receivable. There's the word right there, accounts receivable. So we know we're going to be using the balance sheet because the balance sheet does have accounts receivable on it, okay? And then lastly, we see here that there is currently a debit balance in the allowance for doubtful accounts of $5,000. So by taking this notion, okay, we recognize there's a debit balance. So therefore, our indicator here is to tell us to add. All right? And in this case, okay, we're going to add them together. So what are we adding together? We're going to add our estimated amount, which is the $25,000. And we're going to add the $5,000 to it. And that's going to give us a grand total of $30,000. Okay? All right. I gave you how to recognize the method that you're using. Does this make sense now? It probably doesn't. No. But just understanding this concept. So when we're dealing with bad debt, right? Where does this debit balance even come from? Right? It comes from when we did our previous example, right? If Mr. Sanchez owed us $100 and he decides to claim that he can't pay the rest for the rest of the year, we created a debit balance of $60 in the allowance for doubtful accounts, right? So this is exactly what's going to happen when you've exhausted your methods of trying to collect that money. You're going to realize at the end of the day, Mr. Sanchez is not going to pay me back. It's already been what, 9 months? It's been a whole year. He still hasn't paid me back. So in this case, I'm going to include his $60, but also make my estimated amount, right? Mr. Sanchez is not my only customer. So out of this $25,000, he only owes me $60. At least I know that for sure. But out of my $500,000 of accounts receivable, I'm going to estimate that this percentage, so $25,000 out of the $500,000 is going to be uncollectible. So this is my estimated amount because I can't assume that every single person, right, in my clientele list that owes me a total of $500,000, I have to make the assumption that I'm at risk that $25,000 of that money is not going to ever come back to me. Ever. So in this case, this is what we're dealing with. We're dealing with just taking in the loss because we could just assume, right? Because we have that risk that our clients, we don't know who, we don't know when, and we don't know how much each person, right? Now I'm going to go ahead and safely assume I'm just going to write this off as a loss. And that's exactly what we're doing. We're going to debit our bad debt expense, right? Because it's an expense. And we're going to credit our allowance for doubtful accounts. Okay? With that explanation, does it make a little more sense?
Question.
Yes.
With that estimated amount of 25,000,
Mm-hmm.
do you calculate at a certain percent of that?
Yes.
500,000?
Okay. Yes. Okay. And you're going to notice that most businesses, okay, they use 5%, right? It could be anywhere from 5 to 10% of total amount of accounts receivable, right? Because that's actually the margin of how much loss a company can take. All right? That's the maximum amount that for tax purposes, I don't know, for those who are in tax or have been in tax, you probably know this a lot better than me, but there is a certain percentages that companies must report as a loss, right? Because again, a $1 billion company like Walmart, right? They can have $1 million of it in accounts receivable, right? I'm a Walmart credit card holder and I owe a lot of money on it. Am I going to pay it back? Well, in this case, yes, I will, but it's so much money that I can't pay it back right away. And that's going to be an assumption, right? If I decide to not pay Walmart, then I be placed into this percentage of possible debt that can't be collected. All right? And again, it's anywhere from 5 to 10%, and that's about the amount that you can file for a loss for any business, whether you're small, big, large, whatever you are, incorporated or not. 5% is usually what you normally would see. So, or that's usually a good estimated amount, right? If you can collect 95% of your profits, that's actually really good, right? You never want to take more than 20 or even claim 50% because then your company's going to go down the hole very quick. All right? It makes your company look really bad if you write off this loss. Okay? So, yes, so it is based off of a percentage. Now, in this case, I just took a random number. I just put 25,000 out of 500. I think that is 5%, if I'm not wrong. But yes, it could be any random number. Whatever the company decides to choose, it could be 5%, 6%, 9.5%, whatever percentage that they choose that they realistically, so they're making a projection. Whatever amount that they realistically think that they are not going to collect, that is where we're going to go ahead and place it here. So again, Walmart is definitely going to have a large percentage because most, if you do not know, they allow a lot of low income families to own a Walmart credit card. So they are at a very high risk of possibility of not getting paid. All right, just an example. Okay, so again, to just understand a quick way to just be able to get past this and not truly go in depth because this is dealing with tax in the long run, right? Claiming those losses. Again, if you are going to go into tax, then this is definitely something you want to learn. But if not, just go ahead and use the top portion to just get through this problem because again, you guys are dealing more on, just being an accountant and just recording the transaction that happens. But this is just a way to understand how it happened. Okay, so if you just want to get past this, just use these 3 things that you need to recognize, and you'd be able to accomplish this without having to look truly in depth of why this is happening. Okay.
I have a
So
question.
yes,
So this is an adjustment at month end,
it,
correct?
it could be month end, it could be year end, it could be whenever. Most companies that claim this bad debt, usually they do it either quarterly or even annually. Because I mean, you can't assume you can't assume much every month, right? Unless you're a $1 billion company. Then yes, you can assume. But usually this adjustment would happen towards the end of the year because that gives them 12 months to file for this claim, right? It gives them enough time to go ahead and be that debt collector, right? Try to exhaust as much energy to get the money that they owe, right? So 12 month span is usually a good time period, and yes, this adjustment doesn't have to happen every single month, right? Realistically, if you have a billion clients, you can assume that they're going to make your monthly payment. It's just towards the end of the year or giving them within a 12-year span. That's where you kind of like, um, I'm not quite sure if this person can pay me within 12 months. Okay? I don't know if that makes any sense. All right. Any other questions in regards to this? Go ahead.
I do. Um, you know how we give the discounts?
Okay.
Um,
Mm-hmm.
do is this the area where you write off those discounts too under bad debt, or how do you recoup the money for discounts that you may give a customer?
Okay, so discounts, right? It's a contra account. It's not, so this is dealing with people that owe you the money, not in sales particular. Because at the end of the day, when we're dealing with sales, we're going to close out those accounts. They're going to be zeroed out. So in this case, your sales discount, right? It doesn't necessarily go towards, um, you know, your the amount that you're actually being owed. That's more like you're taking a discount off the profit. So in this case, you're not receiving the full profit. In this case, yes, they are kind of correlated with each other, but in this case, we're only dealing what people owe us.
Mm.
So as far as translating that into bad debt, it's not a matter of fact whether we gave them this discount or not. It's the matter of fact that they're not paying us.
Okay.
Okay? So, yes. Any other questions? Okay. So, we'll go ahead and move on to the second one, okay? So, let's go ahead and do this one. All right? So, for this example here, we have it is estimated at 25,000 of $500,000 accounts receivable is uncollectible. There is currently a credit balance of $5,000 in the allowance for doubtful accounts. Journalize this adjustment. So, go ahead. Let's answer this question together. Okay, so we know that we have to recognize a bad debt expense. We know that our credit at the end of the day is going to be allowance for doubtful accounts. So, how do I calculate this? Okay. And I get a grand total of what?
20,000.
20,000. Yes, because one, we recognize what the estimated amount is. Two, we recognize it's an accounts receivable. Three, we recognize that there is a balance in the allowance for doubtful accounts, and it's a credit. And if it's a credit, we recognize we need to subtract. So in this case, here it is, right? At the end of the day, you're going to recognize that because allowance for doubtful accounts is a contra account, it's a contra account to accounts receivable, right? So just by knowing that piece of information, you're going to know at the end of the day, allowance for doubtful accounts should normally have a credit balance, right? Because it flows in the opposite direction as accounts receivable, right? Accounts receivable is an asset. It's increased by debits. So in this case, allowance for doubtful accounts is going to be increased by a credit. Okay? All right? So good. That's the example here. Now we're going to be looking into the income statement. There you go. Income statement. All right? So if you guys ever seen an income statement before, you're going to notice that you only see sales. You will never, ever, ever see an accounts receivable on your income statement. All right? All you're going to see is your sales, your profit, and the total expenses. So in this case, when we're looking at our income statement method, right, we're going to be looking at two things. We're going to be looking at one, the estimated amount, and two, the word total credit sales, right? And in this case, when we recognize that amount, we don't care whether there's a balance in the allowance for doubtful accounts or not. Because in this case, we're not dealing with accounts receivable. We're only dealing with our total sales. Okay? So by having that piece of information here, let's go ahead and do the example. Okay? So it is estimated that $25,000 of a $500,000 total credit sales is uncollectible. Okay? There is currently a debit balance of $5,000 in the allowance for doubtful accounts. Record this adjustment. Okay? So in this case, same things are going to be recognized, right? We're going to have the bad debt expense, right? We're going to have the allowance for doubtful accounts. But in this case, we don't care what the balance in the allowance for doubtful accounts is, because at the end of the day, what we're doing is we're adding or subtracting to this allowance for doubtful accounts, right? So we don't need to make a notion for it. We don't need to add or subtract. Whatever it is, okay? So in this case, you're only going to take your estimated amount. So here, my $25,000 is going to be my bad debt expense. Okay? Because we don't care whether to add or subtract, right? All we're doing is we're just taking the total amount of sales that are not going to be collectible. Okay? All right. Does this make sense? This one's also a little confusing as well. Okay? Right? This all goes along on which statement you are actually recognizing. Are you recognizing the balance sheet or are you recognizing the income statement? And in this case, we can assume right here, because we're given the keyword here, total credit sales. All right? So here, we're only going to indicate this extra $25,000. And it's going to go straight into the allowance for doubtful accounts. Okay? So let's go over the second example. Okay? Same thing, except, okay, so we have $25,000 estimated amount of $500,000 total credit sales. There is currently a credit balance of $5,000 in the allowance for doubtful accounts. So how are we actually going to journalize this adjustment?
$25,000 bad debt. $25,000.
Exactly, because in this case, we don't care for what amount is in the allowance for doubtful accounts because we don't even see it on the income statement. It has no effect on the income statement whatsoever. So in this case, we're not going to affect any other account. We're not going to, we don't care for whatever the balance is. We're just going to recognize what our total sales is. In this case, it's $25,000. Okay? And we're just going to go, boom, right there. Okay? So now the question is, do I use both methods or do I use one? You only need to use one. Okay? Whichever one makes it easier for you, whatever makes it, easier for you, you can use either or, but you cannot use both. You cannot write you cannot write off bad debt twice, okay? Because then you're taking a loss twice. So whether you choose to either take the total amount of accounts receivable, right? But if you do that, right? If you're doing the balance sheet method, you have to consider the allowance for doubtful accounts because they are both on the balance sheet. Okay? But if you don't care for it and you just want to make it sweet and simple, then use the income statement, which only deals with your total amount of sales. Once you've recognized that, boom. You have your, okay? So you can choose whether to use either or, only use one, don't use both. And if, again, with the whole consistency thing, you need to be consistent. So if you use the balance sheet method, you need to use the balance sheet method for the rest of the years. Okay? If you use the income statement method, you're going to use that for the rest of the years. Okay? And that is pretty much it for chapter 10.1. So here I want you to know a few key things that I want you to take away with. So for example, right, we only use allowance for doubtful accounts, okay, the actual physical one, during the period, right? Because then we recognize who is going to fault on their payment. We know how much is going to be faulted on, and we know exactly when, right? So when we do this during the years, right, we're going to record it like this. We're going to literally debit our allowance for doubtful accounts, and we're going to credit it out of our accounts receivable because it's decreasing it in a sense. Once we reach the end of the period, right, now that we have a debit balance, okay, we're going to recognize, okay, well, if we use the balance sheet method, we currently have a debit balance, okay? If we use the income statement, we don't care, all right? And bad debt is only when we've reached to the conclusion. It's at the end of the period, right? And we're going to make an estimated amount. We're not going to know who, we're not going to know when, and we don't know how much, but we're going to create some kind of estimated amount because realistically, not everyone's going to pay us. So this is where at the end of the period, we're going to claim a certain percentage of those profits, and we're going to, or the amount that people owe us, we're going to claim it as a loss. All right, and that happens at the end of the period. So in this case, we're going to be recognizing a bad debt expense, and we're going to recognize the allowance for doubtful accounts. So again, we learned two different ways to write off bad debt, right? It's the direct write-off method and the allowance method. We, as an accountant, do not use the direct write-off because that's meant for tax purposes only. Okay? Down here, I broke up between the difference between the balance sheet and the income statement, right? Balance sheet, you're going to recognize the accounts receivable. You're going to recognize the allowance for doubtful accounts. Where income statement, you only see sales. Okay? Any questions in regards to this concept whatsoever? This is for dealing with receivables. Okay? Any question about this chapter?
Question.
Yes.
The allowance method, so we can choose either one,
Mm-hmm.
the balance sheet or the income statement.
Correct. But you will be tested on both.
Yeah, I understand.
Mm-hmm.
he or she can use either one of them.
All right, so the accountant is going to make sure that they tell the bookkeeper, I want this method. Okay? But if you're the accountant, then yes, you choose which method works best for your company. Okay? Any other questions in regards to chapter